Ever wish you had like a crystal ball,
Yeah.
um, one that could tell you which stocks were going to take off? Well, today's deep dive might just introduce you to the next best thing.
Oh, is that right?
We're taking a look at a research paper all about SARF. It's this AI model, and it's really making waves in the world of stock prediction.
It's really quite a fascinating thing, isn't it?
Yeah.
When you think about it, trying to predict something as crazy and like unpredictable as the stock market. I mean, it's like trying to predict the weather, but instead of rain or shine, you're dealing with gains and losses.
Right.
There are just so many factors at play.
Exactly. And this paper, it just dives right into that complexity. It shows how even those like traditional methods, they just struggle to keep up. It's like every time someone thinks they figured it out, the market throws a curveball.
Yeah.
But that's where this whole idea of machine learning comes in, right?
Yeah.
It's like the ultimate pattern recognizing machine.
Absolutely. Machine learning models are so good at going through like tons of data and finding connections that we might just completely miss.
Right.
And they're always learning. I mean, they're constantly adapting and evolving based on the information they're fed. And in the world of finance, where data is king, that's a powerful advantage.
Okay, so we've got machine learning, which is already pretty cool.
Yeah.
But this SARF model, it takes things a step further, right? It's
Yeah.
not just crunching numbers. It's trying to understand like the human element behind those numbers.
It is.
It's like, it almost sounds like something out of a sci-fi movie.
It really is quite ingenious. So SARF combines this traditional machine learning model called Random Forest with something called sentiment analysis.
Okay.
So you can kind of think of Random Forest as a team of like expert decision makers, right?
Okay.
Each one analyzing the data from a different perspective, and then they all vote on the most likely outcome.
Gotcha. So where does the sentiment analysis fit into all of this?
Well, that's where it gets really interesting. Just imagine if you could tap into the collective wisdom or maybe even the collective anxieties of like millions of investors.
Oh, wow.
I mean, that's essentially what sentiment analysis does.
Huh.
It figures out how people feel about a particular stock,
Interesting.
whether it's positive, negative, or just neutral.
So it's like SARF is like reading the room, feeling the vibe,
Yeah.
and then it uses that in its predictions. That's pretty wild. But how does it actually do that? Is it like reading through millions of tweets and news articles or something?
You're getting close. So SARF actually relies on this really powerful AI tool. It's called FinGPT.
FinGPT.
Oh. And yeah, it does analyze tons of financial data, including news articles, reports, social media posts, anything that could, shed some light on public sentiment.
FinGPT. Wow, it even sounds futuristic. So it's like FinGPT is the eyes and ears of SARF, and the Random Forest is the brain making the decisions.
That's a great analogy. FinGPT processes the information, extracts the sentiment, and then, feeds that into the Random Forest model. But here's the kicker. SARF doesn't just rely on sentiment.
Right.
It also uses traditional technical indicators, like moving averages and trading volumes.
So it's combining the best of both worlds.
Right.
The cold, hard data and the fuzzy, unpredictable human element. That's what makes SARF so intriguing, right? It's acknowledging that the market isn't just driven by numbers. It's driven by people, by emotions, by narratives.
Exactly. I think that's really where its potential lies. By trying to understand both the quantitative and the qualitative aspects of the market, SARF aims to create a more holistic and accurate prediction model.
I am definitely hooked. Okay, so the paper mentions that SARF uses a bunch of these technical indicators, 15 to be exact, everything from moving averages to something called the Ichimoku cloud, which sounds incredibly mystical. Can you break down a couple of these for us? Like, what makes them so important?
Sure. Let's start with the Ichimoku cloud, since you brought it up. It's actually like a collection of 5 different indicators all displayed together on a chart.
Oh, wow.
It's like having this multi-tool for technical analysis, and it provides insights into support and resistance levels, momentum, and even potential future price movements.
Wow. It's like having a whole trading strategy baked into one indicator.
Okay.
Now, I know you mentioned Bollinger Bands earlier, and I have to admit, the name alone caught my attention. What are those all about?
So Bollinger Bands are all about volatility, like how much a stock's price fluctuates over time.
Gotcha.
Picture them as a channel surrounding the price, and it expands and contracts like a rubber band.
Oh.
So when the bands are wide, it suggests high volatility, like a wild ride. But when they narrow, things are calming down.
So it's like a way to actually visualize how jumpy the market is for a particular stock. That's actually really helpful. And the paper emphasizes the importance of careful feature selection when it comes to these technical indicators. So I'm guessing that means you can't just throw everything into the model and hope for the best.
You got it. It's about picking the indicators that are most relevant to, your specific prediction goals.
Yeah.
You wouldn't use a hammer to screw in a light bulb, right?
Right, right.
The same principle applies here. You got to have the right tools for the job.
Makes sense. But then there's this thing called multicollinearity that the paper mentions. Can you explain that in a way that doesn't make my head spin?
Okay, so think of it this way. Imagine you're trying to bake a cake.
Okay.
And you accidentally put in, 2 cups of sugar instead of 1 because you misread the recipe. Now, the cake will still turn out sweet, but that extra sugar might throw off the texture or, the baking time.
Okay.
Multicollinearity is similar.
Okay, I'm starting to see the analogy. So too much of the same ingredient can mess up the final product. But how does that apply to a stock prediction model?
Well, in this case, the ingredients are the variables you're using to make predictions. And if some of these variables are too similar, too correlated, it can distort the model's results, making them less reliable.
So it's like having too many cooks in the kitchen, like too much overlap, and it leads to confusion and inaccuracies.
Exactly. And that's where SARF gets really clever. It uses some really sophisticated techniques to address this issue.
Okay.
It essentially prunes away the redundant information, making the model more efficient and accurate. Think of it like, decluttering your closet. You get rid of the stuff you don't need so you can find the good stuff easier.
So SARF is like a minimalist when it comes to data. It wants everything to have a purpose, a clear contribution to the overall goal. And I see the paper mentions some pretty fancy techniques for achieving this, like principal component analysis and ridge regression.
Yeah, those are powerful tools for refining the data and making sure the model is working with the most relevant information. They help to address multicollinearity and make the model more stable and accurate.
It's like SARF is fine-tuning its instruments, making sure every node is in harmony.
Yeah.
And then, of course, there's the whole process of parameter optimization, which the paper also highlights. It sounds like SARF is on a quest to find the perfect settings, like the sweet spot for all these different variables.
You could say that parameters are kind of like the knobs and dials on, a complex machine. Adjusting them can really impact the outcome. And in this case, the outcome is the accuracy of the predictions.
Right.
So finding the optimal combination of parameters is crucial.
It's like tuning a musical instrument, right?
Yeah.
You've got to adjust the strings just right to get the perfect sound. And in this case, the sound is accurate stock predictions. So we've talked about how SARF works, but does it actually, work? The results might surprise you.
So the researchers, they really put SARF to the test. They compared it to 2 other models. There was the traditional Random Forest and then something called LSTM, which is this type of neural network.
Okay.
And it's often used to, predict things that change over time.
Okay, so a three-way showdown. And how did our AI prodigy do against these, seasoned competitors?
Well, the results were pretty impressive.
Oh, yeah.
So they measured how well each model could predict whether a stock index would, go up or down over a certain period. And SARF, well, it consistently came out on top.
Interesting.
For example, on the S&P 500,
Wow.
SARF had an accuracy of 78%.
78%. That's pretty darn good. But how did those other models do?
Yeah, so the traditional Random Forest did okay. It was respectable at 67%.
Right.
But the LSTM model, it lagged behind a bit, only 58%.
It seems like incorporating sentiment really gave SARF an edge.
Yeah.
Especially compared to that LSTM, which just looked at the numbers, didn't consider the human element. So it's not just a theory. It actually works. It's like those sci-fi movies where the AI is always a step ahead.
Yeah.
But I'm guessing even with these, amazing results, there are still some limitations or things the researchers want to, explore further.
Yeah, for sure. So the researchers acknowledge that they used a specific data set, right? And to really confirm SARF's effectiveness, they need to test it on more data and under different market conditions, over longer periods of time. It's like if you're testing a new car, you want to make sure it runs well on all sorts of roads and weather conditions.
That makes sense.
Yeah.
You wouldn't want to rely on a stock predictor that only works in a bull market.
And here's where things get really cool.
Okay.
They think that in the future, SARF could incorporate real-time sentiment analysis. Imagine constantly updating those predictions as new information comes in every minute, 24/7.
Whoa, real time. That's mind-blowing. It would be like having your finger on the pulse of the market, constantly monitoring how people are feeling and reacting.
Yeah.
But isn't relying on sentiment a little risky?
Oh, yeah.
I mean, people can be so fickle.
Yeah.
What if everyone suddenly panics and sells their stock, even if the company is still strong?
That's a really good question.
Yeah.
I think it really highlights the fact that we need to understand both the strength and limitations of sentiment analysis, right?
Yeah.
So sentiment can be a powerful indicator, but it's not foolproof. I
Yeah.
think the researchers, they know this, and I think future developments are probably going to focus on refining how sentiment data is, incorporated
Yeah.
and weighted within the model.
Right.
It's about finding that balance between the emotional and the rational.
So it's not about blindly following the crowd. It's about understanding, the nuances of sentiment and how it interacts with those other market forces. This makes me think about all sorts of possibilities.
Yeah.
I mean, if sentiment is so powerful in predicting these stock movements, what other human factors could we analyze? What about like fear and greed
Yeah.
or just, plain old irrational exuberance?
That's a really interesting thought, isn't it? I mean, those are the kind of things that drive market bubbles and crashes. Imagine if we could actually quantify those emotions.
Yeah.
Those psychological undercurrents that drive market behavior. It would be like having a window into the minds of all investors.
It would be like having a superpower.
Yeah.
We could anticipate market swings, predict bubbles, and maybe even avoid some of the financial turmoil we've seen in the past.
Yeah.
But wouldn't that create some sort of unfair advantage for those with access to this technology?
You're right.
I mean, what would that mean for the average investor?
That's a really important question, and it leads us into this area of ethics and accessibility.
Right.
I think as AI gets more and more sophisticated,
Yeah.
we really need to think about the implications for fairness and equity in the financial markets. Are these tools going to be available to everyone?
Yeah.
Or will it create this divide
Right.
between those who have access to advanced technology and those who don't? These are tough questions that we as a society need to figure out.
It's like this reminder that technology, even when it's groundbreaking and, potentially transformative, it always comes with these ethical considerations.
Oh, absolutely.
We can't just focus on the what.
Yeah.
We also need to think about the how and the why.
Totally agree.
But despite these challenges, there's no doubt that SARF is a big step forward in our ability to, understand and predict the stock market.
For sure.
It's a really fascinating convergence of finance, artificial intelligence, and even psychology.
It is.
It's definitely made me rethink how I approach investing. But let's get back to SARF's results for a minute. The paper mentions this table 3, I think it was,
Yeah.
showing the accuracy for different stock indices like the S&P 500.
Right.
It seems like SARF wasn't just, a one-hit wonder.
Yeah.
It actually performed well across different markets.
Yeah, the results were really consistent. Like for the Nasdaq, SARF was really impressive. 85% accuracy.
Wow, 85%. That's a serious edge. It seems like SARF is especially good at, navigating those tech-heavy, fast-moving markets.
And on the Dow Jones, it was still great. 82% accuracy compared to 59% for Random Forest and only 61% for LSTM. It seems like no matter the market, that sentiment analysis gave SARF a real leg up.
It's a powerful reminder that even in the world of finance, where we're always looking at numbers and data, the human element, the emotions, the stories,
Yeah.
they can have a real and measurable impact.
For sure. And I think that's the biggest takeaway we can get from this research. It's not just about building a stock prediction machine. It's about recognizing the power of sentiment, how our collective hopes and fears shape the market.
So what does this all mean for the future of investing? Are we all going to be relying on AI to tell us what to do with our money? Is this the end of human stock analysts?
I don't think robots are taking over Wall Street just yet. I think human analysts still bring a lot to the table.
Yeah.
Their experience, intuition, an understanding of the bigger economic context. But AI tools like SARF can really help them make better decisions.
So it's not about replacing humans.
No.
It's about giving them more power.
That's right.
It's about creating a team
Yeah.
where AI provides the insights
Yeah.
and humans provide the strategy, the big picture thinking.
Exactly. It's about using the best of both worlds to navigate these really complex financial markets.
Okay, now I'm starting to see the potential here. But before we get too far ahead of ourselves, I'm kind of curious about how SARF actually works on a technical level.
Okay.
The paper mentions combining Random Forest with sentiment analysis. But how do those two things actually fit together?
Okay, let's break that down a bit. So imagine the Random Forest model as a team of detectives,
Oh, okay.
each one specializing in a different aspect of the case.
All right.
They gather clues, they analyze evidence, and then they vote on the most likely outcome.
I like that analogy.
Yeah.
So where does the sentiment analysis fit into this? Is it like, a special witness that's giving inside information?
You could say that. Sentiment analysis is like having access to the collective, like, whispers of the market, you know?
Hmm.
The rumors, the gut feelings. It's about figuring out the mood, the vibe, that undercurrent that can be hard to measure,
Right?
but that can have a huge impact on how stocks actually perform.
It's like tapping into the collective consciousness of investors,
Exactly.
understanding their hopes, their fears, their anxieties.
And SARF doesn't just rely on one source for sentiment either. It pulls data from news articles, social media posts, analyst reports, really anything that could show how people are feeling about a particular stock.
So it's like this, super sleuth gathering clues from every part of the financial world, building a story that's about more than just the numbers. But how does it extract sentiment from all that text?
Yeah.
Is it just looking for certain keywords like
Yeah.
buy or sell?
It's more sophisticated than that.
Okay.
So remember, FinGPT,
Yeah.
it's playing a key role here. It's been trained on massive amounts of financial data, allowing it to understand not just the words themselves, but also the context, the nuances, the subtleties of financial language.
So it's like FinGPT is reading between the lines.
Yeah,
It understands the emotions and intentions behind the words.
that's right.
That's pretty amazing.
It is. And once it's figured out the sentiment, it feeds that information to the Random Forest model, where it gets combined with all those technical indicators we talked about.
So it's like this, grand synthesis, bringing together the hard data with the emotions of the market.
Exactly. And that's what makes SARF so unique. It's acknowledging that the market is driven by rational and irrational things. And by using sentiment analysis, SARF is trying to create a more complete picture of what's driving those stock prices.
This is making me think about all kinds of things. I mean, if sentiment is so powerful in predicting stock movements, what other aspects of human behavior could we analyze? What about consumer confidence or political instability, even natural disasters?
You're really thinking outside the box. Those are all factors that can have a huge impact on the market. Imagine developing AI models that can not only predict stock prices, but also, anticipate those bigger economic trends, social shifts, even geopolitical events.
It would be like having a crystal ball for, the whole world.
Yeah.
But wouldn't that also create some ethical problems?
Yeah.
I mean, who gets to see this information?
Right.
How do we prevent it from being misused?
Those are really important questions. As AI gets more sophisticated, we need to be talking about ethics,
Yeah.
responsibility, and the consequences of these technologies.
Right.
We got to make sure AI is used for good,
Yeah.
that it benefits everyone and doesn't just make inequality worse.
It's that whole thing, right?
Yeah.
With great power comes great responsibility. But let's not dwell on the negatives too much.
No.
This research is super exciting. It's opening up new doors to understand the market and making smarter decisions.
It absolutely is. And it's not just about stock prices,
Yeah.
It's about understanding what drives the market,
Uh-huh.
that complex relationship between data and human behavior. This knowledge has implications far beyond just Wall Street. It can be used for economic forecasting, for social policy, so many things.
This deep dive has really been eye-opening.
It has.
We started by exploring this new AI model, and now we're thinking about the future of finance, technology, and, all the ethical stuff.
Yeah, it's really amazing how one research paper can lead to so many questions and insights. And that's the beauty of knowledge, isn't it?
It is.
It makes us think differently, explore new ideas, and push the boundaries of what we thought we knew.
Thank you so much for walking us through this incredible deep dive. You've given us a lot to think about.
It's been my pleasure.
And to our listeners, thanks for joining us on this journey. Remember, every deep dive is for you. It's here to help you stay informed, stay engaged, and, stay ahead of the curve. So, until next time, keep exploring, keep learning, and keep asking those insightful questions.
So we've seen that using sentiment analysis really gives SARF a big advantage when it comes to predicting how stocks will move. But I'm still kind of curious about that LSTM model you talked about earlier, the one that didn't do as well. What exactly is it, and why do you think it had so much trouble compared to SARF?
LSTM stands for long short-term memory. It's a specific kind of neural network that's especially good at analyzing data that comes in a sequence, like time series data, which is exactly what we have to stock prices.
Right.
You can think of it like a brain that can remember patterns over a period of time. It's been used successfully in things like speech recognition and language translation.
Okay, so if it's so good at analyzing time series data, why didn't it do better at predicting stocks? That's the million-dollar question. And I think it highlights a really important thing about the stock market. It's not just some kind of machine that runs on numbers, you know?
Yeah.
It's influenced by how people act, by emotions, by all those stories that get told about companies. LSTM, with all its computing power, is still just focused on the numbers. It's missing that human element, which is exactly what SARF captures with sentiment analysis.
So it's like LSTM is this incredible mathematician, but SARF is like a psychologist who gets how people think and feel and how those emotions can actually move the market.
I love that analogy, and it really emphasizes why this research is so important. It's not just about making a better stock predictor. It's about recognizing that the market is this complex thing affected by both rational and irrational forces.
It's like we're finally starting to crack the code of the market, you know? Understanding the whispers and the shouts, all the hopes and fears that are behind every single move. But this brings up a big question. If AI can predict the market what does it mean for everyday investors, like you and me? Could this give an unfair advantage to people who have access to these kinds of tools?
That's a really important thing to think about. And it brings us to the whole issue of ethics and accessibility. As AI gets more and more advanced, we have to figure out how to make sure everyone has fair and equal access to it. This is a conversation we need to have as a society, involving policymakers and regulators and the tech industry.
Right. It's like a reminder that technology, even when it's groundbreaking, it could change everything. It always comes with these ethical questions.
Yeah,
We have to think about more than just what it can do. We
exactly.
have to think about how and why as well.
Absolutely. But even with all that, there's no denying that this research is exciting. It's giving us new ways to understand the market and make better choices. I totally agree. And it's not just about predicting stock prices. It's about understanding the forces that move the market, how data and human behavior work together. This kind of knowledge is important beyond Wall Street. It affects things like economic forecasting and social policy.
Wow, this deep dive has been a real journey. We started off looking at a new AI model for stock prediction, and we ended up talking about the future of finance, the role of technology, and how important ethical questions are.
It's amazing how one research paper can make you think about so many things. And that's the great thing about knowledge, isn't it?
It is.
It pushes us to think differently, to explore new ideas, and to go beyond what we thought was possible.
Thank you so much for taking us on this deep dive. You've given us a lot to consider.
It's been a pleasure.
And to our listeners, thank you for joining us. We hope you enjoyed learning about SARF and what it all means. Remember, we make these deep dives for you to keep you informed and engaged, and help you stay ahead of the game. Until next time, keep exploring, keep learning, and keep asking those great questions.